Welcome, everyone, to the 14th episode of the Asset Admissions Podcast. I'm your host, Mathieu Jacques. I'm joined here by Yan Desforges, which is a mortgage broker of over 14 years of experience now.
14 years, yes.
Yeah, beautiful. So we got someone knowledgeable at the table here.
Thank you. I'm trying.
So I wanted to start the podcast by giving you the mic to explain a bit of your course and how it went along your 14 years.
Okay, well, thank you. So first off, I started about, I'm going to say close to 20 years ago in the banking world.
Okay.
Yeah, so I started at Desjardins actually as a teller. I was 20-year-old at the time, so pretty young guy. Started there, and I actually really enjoyed my time over there. So I really learned a lot. And you can basically grow a lot when you want to at a bank or at a Caisse Populaire or at Desjardins or wherever you got to work.
Lots of opportunities.
Exactly. And you can do pretty much everything, right? So you start by being very generalized. So then I became like a financial advisor, but a kind of a junior financial advisor, which is kind of more generalized, And then when I purchased my first home, that's where I made the click, right? So I said, "Oh wow, okay, that's pretty cool. That's really something I'd like to do, and I think I could actually do it, and I could actually be good at it."
There we go.
So that was kind of really interesting. So that's where the starting point actually started. So I became then a financial advisor, but doing mortgages internally at the branch level. Then I became later on a mortgage representative, which is basically my own business, but still working for one bank, which at that time was Desjardins at that time.
Okay.
So I worked as a mortgage specialist for a little over 9 years then. And then I made the switch to become a full-on broker. So I decided to make the switch to become a broker basically just to have access to more than just Desjardins specifically. So I knew that by having access, I could provide a broader range of options to my clients. And that's exactly what I wanted to give my clients. The opportunity to have more accessibility to it.
It can be more tailored, right?
Exactly.
To the exact situation of the client.
You got
right?
it. Absolutely.
Like we've been doing quite a bit of deals lately together, and you're always able to adapt yourself because you have many more banks to lean on now.
That's correct.
So you're able to adapt to the exact situation and find the perfect solution for the client.
Exactly. So
Yeah.
I have access right now to 62 lenders in total. That's not even 62.
Wow.
That's correct. So that's not even counting those private lending and stuff like that. I'm just counting those typical A and B lenders. So an A lender is a typical bank, and then there's the B lender, which is a little bit more alternative. They allow a little bit more leeway when it comes to credit ratings, when it comes to income, or to TDS, which is the total debt ratio.
Okay.
So an individual can be at a little bit of a higher level of debt to go to a B lender.
So the cost to that would be having a higher interest rate.
You got it.
That's it, eh?
That's correct.
Okay.
That's
So
correct.
Everything comes with a price.
Everything comes with a price, but so I have access to those 62 lenders in total, and then you go the private side. And the private side, there's pretty much there's so many options.
Oh, yeah.
And then you can be really creative when it comes to that. So you see, so you can be very tailored and have specific opportunities for the client, depending on the client situation, depending on the client needs, but also depending on the client, what they're looking for. Am I looking for the best rate? Am I looking for a HELOC, a home equity line of credit? Am I looking for just a mortgage alone? Am I going to buy and sell another house in 2 years from now? These are all stuff that we need to have that conversation together. And
Most definitely.
That's why I'm doing that job.
Well, you're really good at it.
Well, thank you. Okay, I'm trying.
So you started at Desjardins.
Yep.
And now, I don't think you've mentioned it, but now you're at Capital Mortgages.
That's
the
correct.
name of
The brokerage.
The brokerage.
The brokerage.
Okay.
Yeah.
So it's similar as eXp Realty for us realtors or
Absolutely.
Royal LePage.
Yeah. That's pretty much what it is. So when you became a broker, you got to affiliate yourself with a brokerage per se. So you need to affiliate yourself for at least a minimum of 2 years before you can actually open up your own brokerage.
Okay.
That is if you want to, of course, because there are costs, there are expenses, you know what I mean? Like sometimes you got to think about it. And so that's where I became a broker with Capital Mortgage directly. So yeah, Capital Mortgage is a brokerage per se, and I think we're close to 40, maybe 50 agents in there. Yeah,
Okay,
yeah,
okay.
brokers if you prefer.
That's it, exactly. And so you do business pretty much everywhere in Canada?
My God, man. Nowadays, it's anywhere in Ontario.
Okay.
In Ontario. I mean, you
In
can
Ontario.
finance outside the country, but myself, I am licensed for Ontario specifically.
Okay, that's
You-
it.
you
So
gotta
you're
be
licensed
careful.
for Ontario, but you reside in Quebec.
That's
actually.
correct.
Yeah.
Yeah.
Okay.
But that's a funny story. About 4 years back, we decided to switch house. So basically, we kept the house we have and we rented it out. Anyway, long story. But we were thinking about moving to Ontario, and we decided to stay on the Quebec side. But I wanted to be closer to where I do most business. Let's put it that way, because nowadays you can do business pretty much everywhere you want.
Oh, that's it. Everything's
Yeah.
online now, so.
But my core business, if I can put it that way, the core business that I really developed is more from, let's say, Ottawa to, I will say, Eastern Ontario, the whole Eastern Ontario.
Yeah.
So that's pretty much my core business, right?
Okay.
So that's why I chose to go just the other side of the river from Cumberland. So I'm
Oh, there we
about-
go. So you got the ferry right there.
Yeah, you got it.
There
man.
we go.
So I'm
yeah.
about 5 minutes from
Oh,
the
you're well
ferry.
located.
Yeah, exactly. So I can go everywhere pretty quickly. But nowadays, everything is done virtually. So
Exactly.
you don't meet a lot of client face to face, which I think it's sad, honestly. Since COVID, and I know we're going to talk about it later on, but since COVID, we don't meet lots of clients on a face to face basis.
No, that's it. It took
Yeah.
away a lot of that charm and a lot of that. You need proof. You need to prove yourself. I feel
little
like
bit
to a
more.
client.
Yeah.
And now online, if someone reacts quicker than you, for example, to a new client that comes in, that can be sealed. That can seal the deal with that client.
Absolutely. And
When
he
you
just
were in
wants the deal.
person, you need to prove yourself. You need to show that you're well put together.
Yep.
You need to come in with a clean car and not have it dirty. There's
Exactly.
many factors to
Yeah.
it, right? And you had to have a physical material as well.
Yeah.
So there's a cost to printing. There's a cost to driving to get there.
That's
so there
correct.
were many nuances, and now we turn to just facilitating the process. But the downside is if you're not responding quickly, you may lose. You may lose it because the
the
competition
key.
is all reachable online.
That's the key,
Yeah.
man. Honestly, if you're not quick on the ball, if you don't return your phone calls, if you don't return your emails, if you don't return your textos, if you're not quick on the ball,
Exactly.
you're going to lose the client.
Oh yeah, oh
gonna
yeah.
lose
Like
the-
everyone can reach everyone. That's where we're at today.
Yeah.
So what has changed in all your 20 years in the banking industry and 14 years of working with mortgages? What has changed in the Canadian mortgage markets? What are the most notable changes?
A lot.
Yeah.
A lot. So that's actually a pretty good question, man. First thing, the one thing that I noticed the most is it's harder and harder for Canadian to buy properties.
Yes.
Yeah. So when I look at the real estate market, it's more and more hard for Canadian to be able to actually purchase a house, and especially for first-time home buyers. So I know that like we now have those incentives. There's stuff going on that can actually try and help those first-time home buyers, for example. But it is harder to actually buy a property nowadays.
Most definitely.
Absolutely.
Like that's for sure true. And I think there's
basically-
many factors to that.
Yeah, exactly,
Like
exactly.
it may be mortgage rates,
Yep.
but that has a play. But there's also housing prices.
Yep.
There's also the amount of demand that's coming into the market. You know, we're near a capital. There's a lot of immigration that comes down here, so that brings a lot more demand as well.
Offer and demand.
Exactly. And I feel like regulations have changed while you're there as
That
well.
is correct.
Right?
That is correct.
Because, anyways, I think you can expand upon that, but I'd say because of the 2008, what happened in the United States,
Yep.
I assume that Canadians or Canadian banks now had more regulations and needed to, check the buyer even more, perhaps have higher qualification standards.
That's actually a good point, Matt. So one thing that affected significantly buyers from getting a mortgage approval and was getting them, like, it's harder to get approved on, it's because of that stress test. You know, I don't know if you heard about it, but when you're trying to qualify a client to buy a property or for financing a property itself, you need to qualify them based on a stress test, which is basically the highest between the rate that we provide plus 2% or 5.25%, which is the Bank of Canada benchmark rate. Okay, so the highest of them two. So let's say, to give you a quick example here, if I say I'm going to give you 4.5%, that's the interest rate I'm going to give you today. All right, cool, fair enough. And you're really happy with that. But I have to qualify you based on a payment that is based on 6.5%. See what I mean?
So there's a buffer put on there.
Yeah. It's called the stress test. In our language, we call it a stress test. The official term, I think it's the Bank of Canada qualification rate.
Yeah.
So that was implemented back in, I think it was 2010 or 2012. I'm not going to lie to you. I don't know the exact date.
Okay, so I have a question
but it's been a while.
here. So for variable rates, how do you calculate that 2.5% higher on variable rates? It varies. It's in the name.
It varies, but we have to go with what we offer initially, right? So if the variable rate right now is at 4.5 again, let's take the same example, variable rate at 4.5, I'm still going to qualify you at 6.5, although we don't know what's going to happen to the future.
Yeah, right? Okay.
So that's how we generate that stress test. So even if on a variable rate, we work the exact same way. So we always use whatever rate we can provide today on a variable rate plus 2%.
Okay.
But the lowest, the benchmark, the lowest we can use is 5.25 right now. I think when it started back then was at 4.64, 4.74 was the lowest point, the benchmark. So even if, let's say, I provide my client with a 1.5% rate, so I technically would qualify them on 2.5, or I'm sorry, on 3.5, I'm sorry.
Yeah.
But since the benchmark was, let's say, 464, I needed to use 464. So you can see it, back then, we didn't have that.
Yeah.
So before that, if I give you 4.5%, well, I was qualifying you on a payment of 4.5%.
That's it.
But now we have to use 2% higher payment, 2% interest rate, higher payment.
And so when was that stress test regulation added?
I think it was probably around 2012, I'm going to say, roughly.
Okay.
Roughly 2012. It started with those first-time home buyers initially, and then it spread it out to pretty much
every mortgage.
Every mortgage.
Wow.
Yeah. So government actually changed that policy quite recently, okay? So January 15th of 2025, when you do a switch, which means that you just basically transfer your mortgage from one bank to another bank, now you do not have to use that stress test anymore.
Okay, interesting.
Yeah, they did that change specifically for one reason, because they knew that there's a whole lot of mortgages that are coming up for renewal.
That's it.
Okay, and the interest rate went up significantly.
Yeah.
Okay, so there's a whole bunch of people that actually had a crazy good rate, and now they have they're gonna get offered a significantly higher rate. So to try and avoid those kind of...
To absorb that shock.
Exactly.
Absorb the
as
shock.
much
I think
as
that's
possible.
Yeah.
Not have to, then you'd be stuck with your own bank. I mean, you cannot transfer to another bank.
Yeah.
You know what I mean? Because
That's
you
it.
don't qualify anymore.
And you'd have to accept the rate that they give you, and that's it.
all.
You can't even shop at all.
Cannot compete.
That's it. Yeah,
You know?
That's a tricky position.
That's really bad. That's really bad.
Yes, it is.
Yeah.
Yes, it is.
So that's why to switch, they created that.
Yeah, so from my research, approximately 60% of mortgages currently outstanding are going to be due between 2025 and 2026.
That's correct.
That's
a lot.
That's a huge amount there.
That's
a
lot.
huge percentage. And keeping in mind as well that, I'd assume most people lock in for 5 years or have 5-year terms on average.
Yeah,
So
that's
keeping in mind that we were in 2020 back
Yep.
then, while it's renewing in 2025 here. In 2020, between 2020 and 2022, the Bank of Canada had lowered interest rates. That's the overnight funds rate to 0.25%. That's pretty much as low as it's going to get.
The lowest
It's on the
point.
ground. It's
Yeah,
on the ground. Essentially,
absolutely.
borrow money. It's cheap. Money's cheap.
Yeah.
Go buy a house. Do whatever you want. Money's
Yeah.
cheap. We got an abundance of it. But what happens when there's an abundance of currency supply like that, and especially when businesses are forced to close? For example, gym, restaurants, and places that are not deemed necessary services according to the regulatory oversight. What happened is we saw hyperinflation in the asset market.
Yeah.
So, where can you put your money if you can't run your business? Well, you can put it in real estate.
Yep.
You can put it in gold. You can put it in stocks. You can put it in art.
Yep.
You can put it in assets, because those you can still buy them even though the main street economy is still not running at its fullest.
Yeah.
So that's what happened. There was a big overflow of currency, Canadian dollars. From my research, between 2020 and 2025, 33% of the currency supply was printed, so issued by the government.
Well, you see.
So
Yeah.
that's a third of the amount of Canadian dollars that are in free flow in the Canadian market
Yeah.
that were printed. So
Even though the whole economy was actually slowing down and businesses were closing and stuff like that. So,
exactly, and the excuse is to stimulate the market, right? It was to get stimulus checks. They literally called them stimulus checks,
Correct.
and there was a lot of government subsidies because government had cheap money to borrow, so they had cheap money to give to their
Yep.
population, right? So that's the view they took. And what happened to housing since 2020?
Yep.
Housing has on average appreciated by 48% here in the Ottawa region. That's detached houses
insane. That's insane,
48%
Yeah.
in 5 years.
That's a
Telling your population that they've lost 50% of their purchasing power
what I was
against
gonna say.
housing in their capital
Yep.
in 5 years. That's
Yep.
literally what it means. So that's 9% of appreciation per year if
Yeah.
we do an average for those 5 years. So walk us through how it was in the mortgage business during those times.
Yeah, well, I mean, people wanted to sell. There was a surplus of immigration too, so there was a huge
Yes.
demand, right? And these guys, these new Canadians, they also wanted to buy houses, but there weren't enough properties available. Okay, so what happened there is again same thing, offer and demand, right? So there's lots of demand, but not enough offer. So at the end, it's going to inflate the price range. So
Yes.
it was getting harder and harder for people to actually be able to qualify at one point. But the thing is that interest rates were so low that it makes it a little bit easier for people to be able to qualify, even with that stress test I was talking about previously. See? So we saw a lot of transactions going on, and people were actually, they made money. They had money,
Yes.
I mean, even if businesses were closing, stuff were going down, but you're staying at home and you're still making money. My God, I'm working from home and I can make the same amount. And also keep in mind that the Ottawa region, we're very government owned, right? We're very government workers.
Yes,
That's
of
what
course.
I mean.
Yeah.
So not many people actually lost their job. I mean, we're not going to close the government. It's you're still going to work, but your work is different. You're going to work from home.
Yeah,
mostly.
working from home, exactly. And
Yeah.
that's one thing I find interesting.
Yeah.
Is office buildings in Ottawa
Yeah.
doubled in price in that time frame,
Yeah.
yet are not rented and are not being
Empty.
used.
Empty. That's
Explain
funny, eh?
that.
Yeah, I don't have the explanation
Yeah.
for that one. I'm sorry, man. Yeah, that's really strange. But
Yeah.
but yeah, so people were rethinking the way that they wanted to live, right? So
Yes.
am I still gonna need my condo downtown Ottawa? Well, maybe not. I've always dreamed about working and not working, but living on the countryside. Well, now maybe I can. And I can afford it because my condo actually gained 20, 25, 30% increased value over the
Exactly.
last
So
2
why not
years.
sell it and buy something else?
Exactly. I'm going to make a huge profit from selling my condo unit. And I can actually, surprisingly enough, I can actually rent it out,
Yeah.
keep it, rent it out, refinancing because I gain so much equity from that property. I can actually refinance it. And from that refinancing, there's my down payment. So now I can actually buy my own piece of land and build my property or buy a new build in the countryside and have my beautiful house where I can actually work from there because I think it's going to be like that for a long time now.
Exactly,
See what I mean?
exactly. And I think that's why we saw a lot of expansion like that to the east. I've been in the area for
Right.
2 years now, and I wasn't used to seeing big developments. I'm from up
Yep.
north, and there not much going on
No,
there
no, no.
as far as developments. But
Yep.
when I came down here, there were 2 builders building in Limoges. Now there's
Yeah.
5.
Oh
That's
my God. You
25
see?
minutes east of Ottawa.
Well, there you go.
So I feel like as the demand, I mean, the supply is starting to head there as well. It's a
Yeah.
bit delayed.
It is.
But yeah, people were looking to get out of the city center as it was less needed to
Yep.
stay, right?
Yeah,
So
absolutely. And these people were able to put decent down payment on the property, which makes it easier to be able to qualify then for a mortgage, you see? So, and also you got to keep in mind that in the mortgage business, when you look at an individual or a transaction per se, well, we also look at like what's your down payment. So what's the risk involved for the lender? That's also my job. My job is to work for the client, but also I do still also represent the lender too, right?
okay,
So I
interesting.
kind of represent both worlds. My goal is to get the best of the best for the client, but also I have to respect the lender's policy too.
Yes,
Right?
because they have conditions
Yeah.
to get it, giving financing.
Absolutely, absolutely. And then one of the things that the lender will look at is what's the risk involved for me, the lender. Okay. And if I tell the lender, well, my client here wants to buy a house with 20% down, or the next client here wants to buy a house, the same house with 50% down, well, the client with 50% down, there's significantly less risk. So the lender will allow me maybe sometimes to actually give a better rate for that client. See what
Okay,
I
that's
mean?
interesting.
Yeah. So there are some kind of brackets here when it comes to the lending world that when you put, like, let's say from 0 to 20% down payment, well, it's an insured mortgage. So you got those mortgage insurers like CMHC and Sage in Canada. There's Canada Guarantee as well. So there's basically 3 mortgage insurers in the country. But anyway, so these guys allow Canadian to buy house with less than 20% down. Okay.
Yes.
So then there's the rate for these guys, okay?
Yeah.
When you buy a house with less than 20% down. Because the mortgage is insured, there's absolutely no risk at all for the lender because it's the insurer that takes the risk for the lender.
That's
if something goes bad, the insurer will take the loss.
So, but the
Okay.
insurer or the insurance
Yep.
is a cost to the home purchaser, the mortgage assumer.
That is correct.
Okay.
So everything has a cost, right?
Yes.
Yeah.
Yeah.
So at the end, if you're buying a house with less than 20% down, there's a higher risk involved for the lender and or the insurer as well. But the cost for you as an individual, well, you'll have to pay a premium, which is the insurer's cost to actually be able to insure your mortgage and say, yes, you can buy that land or that piece of property with 5% down.
Yes.
See?
Okay. But
So-
here's your cost because we insure your mortgage.
That's correct.
And so, but when you surpass 20%, now
Yeah.
you're no more. You're not insured anymore.
You're not insured anymore.
So your interest rate goes a bit higher. Is
A
that
bit
correct?
higher, that's correct, because it's basically the lender that takes all the risk. So the lender will say, all right, I'm going to do it still with 20% down, but I'm going to ask you to put, let's say, I'm going to charge you 0.10, 0.15, 0.20% more than what I would have charged you if it was an insured mortgage.
Yes.
20% down or less. See?
Okay.
Because I'm taking all the risk on my part, you know? It's not split with the insurer or not all on the insurer's side. I basically take all the risk.
It's just a lender.
Yeah. And
yeah.
then you move on. So as you grow your down payment, well, the lender is less and less at risk.
That's
right?
it. I think there's another bracket at 35% up
That's
there.
correct. That's correct. Once you hit that 35% bracket for the down payment or more, well, even if you, let's say you put 50% down, you won't get a better rate. Past 35% down payment, you won't
Okay.
get a better rate. That's
Oh,
what I mean.
so okay,
Yeah,
okay.
yeah, yeah, yeah.
Yeah, yeah, yeah.
So even if you increase that to 50%, you won't get a better rate. So
Yeah.
at 35%, that's pretty much a benchmark that you maximize your interest rate.
Okay,
Yeah.
because do you go back to the rate as if you put 5%, but then you don't have the insurance? Is that what
Usually,
it
that's
is?
pretty much what it is.
Okay.
You're good.
That's
Yeah.
interesting. That's
Yeah, yeah, yeah.
interesting.
Don't know
Yeah,
if
yeah,
I've
yeah.
ever told you that, but yeah, you're good. You're good. That's pretty much what it is. Once you hit that 35% down payment, most of the lenders will allow to give you the same rate as if it's an insured mortgage. So as if you actually put less than 20% down.
Yeah.
See what I mean?
Yeah, yeah.
So you get the best of the best.
That's it. Exactly.
That's
The
it.
best of the best. You have equity in your home. You
Yep.
know, you have a tangible asset. It's reassuring.
Absolutely, it
You
is.
can feel confident in that position.
Yeah.
Okay, so let's go back a bit in the 2020 to 2022 era,
Yep.
where the interest rates to borrow for a mortgage went as low as 1.82%.
Actually, the lowest I gave was 144.
144.
144. Yeah, man. Yeah,
Oh
yeah,
my God.
Yeah,
The money was
pretty low.
so cheap.
I'm not gonna lie to you. I think it lasted maybe 2 weeks.
Okay.
But yeah.
Okay. Wow.
Yeah, we were.
I wish I
really
was
shocked.
buying a house in those 2 weeks.
I wish too. I wish too. I bought actually very close to that,
Yeah.
but not there.
Okay.
So
okay.
yeah. Anyway.
So, what challenges did borrowers face in that time period? Because, okay, money was cheap to borrow, but, you know, housing
Yeah.
was raising. There was a lot of multiple offers, for example.
Yep.
You know, how did you guide them through that? What's your perspective on that?
Okay, so that's a hard one, honestly, because we had to work really close, hand in hand with the realtor themselves. You know, the best scenario here was communication, right? So it's always in the best interest of the client. Okay, so at the end of the day, the more we can communicate, all three of us, the client, the broker, and the realtor, to actually get this done for the client in his or her best interest, you know?
Yeah.
So, but I'm not gonna lie to you, it was hard. It was hard.
Oh, it
'cause-
must have been.
Yeah, exactly. Because you saw like those multiple offers and people were discouraging. Like, well, it's the third, the fourth, the fifth house I'm making an
that we
offer
lose
on
now, yeah.
that I lose, you know?
Yeah.
Because someone actually just came higher, or the issue also that we saw very often, and you can also tell me that, is conditions. So people were buying without any conditions whatsoever. So you're putting yourself at risk, though.
Yes.
So then a client asked me, well, is my pre-approval solid? Well, at the end of the day, your pre-approval is as solid as the information that you provide to me. See what I mean?
Yeah, yeah.
Like, we're going to try and cover all the corners for you to make sure that you are secured. I mean, you don't like any nasty surprise, but I don't like any nasty surprise too. I want the deal to be done in your best interest. So my goal is to protect my client as much as possible. So when I do a pre-approval, I had to, and it was even more important in those days, I had to overview everything as much as possible. So that if the client decided to make an offer without financing conditions, for instance, well, he was as much secured as possible. We looked at pay stubs, we looked at T4s, we looked at bank statement. Is there any issues that could pull up from any of those documents, you know? Because then we review it, and once the client actually makes an offer, we send it to the lender, and then the lender actually accepts it, reviews it, or say we're upset conditionally to providing additional documents or additional information. So we were trying to avoid, and we still are, trying to avoid as much as possible these kind of situation where, I did not see that coming,
Yeah.
and then the file gets refused for whatever reason. So I never had that. Well, I guess I worked hard on that, but I was going to say I'm lucky enough to never had that transaction go south.
Good.
Yeah. To say to a client, you're good to go for, I don't know, let's say $500,000. He buys for $500,000, and unfortunately, I didn't see something. You know what I mean? So
Yeah, yeah.
never happened, and that's why we're working so hard. But in these days, that's pretty much what was the most important. But I mean, at the end, clients were still struggling because there so much offer, but there were so many demand. Again, demand and offer. Again, same thing. So if we are 4 people want to buy the same chair, well, the price of the chair might actually went up.
Of course. Of course.
And then there's a 5th one will come in and say, I'm going to offer $100 more than everyone here.
Yeah.
And okay, well, what can you do? Take it. You know what I mean? So we just lost the chair. Let's move to the next one. See? So that's the same way in the real estate, and that's what we saw back in these days.
Exactly. And I don't know how many builders were building during those times. I don't know if that was deemed an essential service or not. But you know what also happens is if the money supply grows faster than the amount of houses that come on market, which has always been the case, but if it amplified at that point, what happens is you need more dollars to purchase what is being produced less of. You know, if you do have just one chair, like your example, there's 10 people that want to buy it. Everyone has $1, but then a government, per se, starts a printing press and says, you know what? We're adding $5 to each person, but there's still just one chair. People will be ready to pay more for that chair. But the only thing that it means is their dollar lost purchasing power. The chair did not go up in value. I can sit down on any chair like any other chair. It's just there's more dollars in circulation. It's as simple as that.
And it's temporary, right?
Yeah.
Like I'm going to give you $5 more income, but it won't last forever.
No, that's it.
You see what I mean? That's what I mean. I mean, the value of the asset, the chair that is increasing, same thing in real estate. I mean, the property were growing up in pricing. So, I mean, it's probably going to stick. I don't see the market going down in value. That's my perspective.
Me neither.
But what I mean by that is people were still working, and then on top of that, they were getting some extra surplus of cash flow, extra money, basically coming from the government, and then they were able to actually buy these properties, and cost of living was still low at that point in time.
Well, I mean, inflation could not manifest in consumer products because we could not consume. The businesses were closed, right?
Yeah.
And also, well, the basket of CPI is always arbitrary and is always adjusted. We call them hedonic adjustments, and it gets adjusted subject to, you know, to make it look as low as possible. In 2023 was the highest that we've seen, which was 5% CPI, if I'm not mistaken. And I mean, against housing, it was 9%, which I've established earlier that we lost purchasing power of. But against, say, your coffee in the morning, it may have just been 5% in 2023.
Probably, probably. But still, it wasn't livable. I mean, it wasn't something that's gonna stick forever. You know. So your income is not gonna increase that much forever and ever, and your buying power at one point will fire back on you or backfire on you. That's what I mean. So inflation will start to rise up, and then it's going to be harder to buy. See what I mean? So, so at one point, that's pretty much what we saw there. It was really, really hard for buyers to actually make that move. There was still lots of transaction going on. Honestly, the market was going nuts. People were definitely buying. But for a buyer itself, it was hard because you had to go over asking price. There was the stress factor that, well, if I'm pre-approved, am I sure, like 100% sure? And it's never 100% sure. You see what I mean?
Yeah.
Until we get that letter from the bank, it's never 100% sure. We might be 99% sure. But you still need that
1%
letter.
chance.
Yeah, exactly. So you just want to secure your client as much as possible, you see? So it was hard on people. And actually, like, first-time home buyers was really, really hard on them.
It must have been.
Yeah, because they're still doing lower income. Jobs were hard because, I mean, everything was closing down. So it was hard on them to actually be able to make that move.
Yeah, that makes total sense. And the reverse is true today. I mean, interest rates are higher, and it's harder for them to qualify today again.
Even higher.
So, you know, it's hard to put their foot forward and get a first property.
Yeah.
Like
no. Even nowadays, I mean, things, it changed, but differently, you know?
So right now, today, what interest rate are we looking at for, say, a 5-year fixed mortgage? mortgage?
It really depends on the project, man. Honestly, are we talking of a rental property? Are we talking an insured mortgage? Or are we talking a owner-occupied, but you're putting 20% down? So
Subject to the situation.
yeah, to give you kind of a ballpark idea here, basically for, let's say, a typical insured mortgage, we're looking at the low 4%, maybe the high 3%, low 4%. I'll put it that way.
Okay.
Let's say most of the lenders will offer between 4.14 to 4.24 to kind of give you an idea.
Okay.
That's always based on a 5-year fix, by the way. I mean, because it's probably what 80 to 90% of individuals actually will take.
Okay, so it is very, very common.
Very, very common. The 5-year fix, because it's something stable, right?
That's it. If you can qualify for those payments and you're comfortable with them, at least you'll know for the next 5 years, theoretically it works out unless your income does go down.
Exactly.
But,
but I mean, at the end, that's where myself, the broker, comes in and say, well, based on what you said, okay, well, Yan, I think I'll be living there for only 3 years because it's a stepping stone, right? So I'm buying that property. So I'm a first-time home buyer. I want to buy my first house, but I know I just graduated from university. I know I make lower income right now, but I know I will be making significant amount or a good increase income over time very soon. So I think that in 3 years I'll be able to buy. Or you know what? Right now I have a girlfriend. We've been together for a while now. But we're not ready to buy yet together. Maybe in 2, 3 years, 4 years from now, we'll see. But right now, it's not the case. So these are the type of situation where, well, maybe a 5-year fix is maybe not the best fit for you, honestly. Because then if you sell the property in that 5-year period, then you'll have a penalty to pay. Yes, there's ways that you can move around, but you're going to be stuck with the same lender. So if let's say if you have that property 5 years, you take a 5-year fix, fair enough. And then you sell it in 3 years and decide to buy another house. Well, to avoid to have to pay that penalty, you will have to port that mortgage to the other property. See what I mean?
Yeah.
So then a port is basically we take the mortgage that you have currently and we switch it over from one property to the other one. Okay. Then you can do a blended rate too, which is a blended of 2 rates together. So let's say you still owed, I don't know, $250,000 and you need a $300,000 mortgage on the next house. Well, we're going to port the first $250,000. So you're going to keep $250,000 at the same rate that you currently have.
So there's no penalty to that?
No penalty to that because basically the lender is not losing.
Yeah.
Right?
Yeah. That's if you remain with the same lender.
That's correct.
Okay.
Now, well, that's the issue.
Yes.
That's the issue.
That is the issue.
Yeah. So you have to stay with the same lender. And sometimes it's actually, depending on the rates that we can offer back then, so 3 years later, what might be actually more profitable to say, you know what, let's pay that penalty and let's get a better rate because the interest rate that I will save will cover the penalty and more. See what I mean?
Yeah.
So it really depends. So that's why question or KYC, I think, know your client. Okay, that's how we call it in our business, KYC. So you got to ask those questions. Okay, so what's your goal here? Are you going to live there for 2 years, 3 years, 5 years, 10 years? You don't know. Okay, you might not know for now, but you might already have an idea. Okay, Yan, it's a stepping stone. All right, so if it's a stepping stone, do you think you're going to sell in 5 years or you're going to sell in 2 years, 3 years? What's the plan here? So if you say, well, yeah, I think I might actually be able to sell it in maybe 3 years from now. So, all right, well, maybe a 5-year fix is not the best fit for you.
That's
it. Here's the reason why. Because you're going to be stuck with the same lender if you want to avoid that penalty.
And so to go with a 3 years fix, for example, what are the interest rates approximately to those?
Usually it's a slightly higher interest rate. Some banks still actually offers the same 3-year fix as a 5-year fix.
Oh, that's interesting.
Yeah, Scotia, for instance, is one of them as we speak right now that offers the same
and it
3-year,
always changes,
5-year.
right?
It changes. Yeah, we can talk tomorrow and I'll tell you a different speech.
That's it.
Yeah, definitely.
Okay.
So, but typically speaking, when you compare a 5-year fix to a 3-year fix, you usually will have about a 0.10 to a 0.15% difference higher with a 3-year fix versus a 5-year fix.
Okay.
Okay, but that's usually what the goal here. We normally go with either a 3 or a 5 year fix. So it depends on the forecast as well, what we see coming as of rates. Like if we see that rates will significantly go down in a shorter period of time, well, I might recommend my client to go on a 3 year fix because of that instead of locking in for a 5 year fix. But on the other side, if I see that the client needs stability, see what I mean? Like first-time home buyers, stuff like that. It's their first home. They're kind of getting used to that. So the feel of paying a mortgage and stuff like that. So maybe a 5 year fix would be best for them.
Yeah, that's why you're there. You're there to tailor the service to exactly what they need.
That's the idea.
That's why I'm there
That's the
for my
idea.
service as well. So, and it's always to represent the best interest of the client.
Correct.
We give our recommendations, but the decision always comes down to them in the end. Right?
Absolutely. So you say what's out there, trying to keep it simple, and then you give some recommendation. So based on what you provided me as information, well, here is what's available, and here is what I would recommend you to do. Then you take your own decision. I mean, at the end, it's you who's going to sign at the bottom, not me.
That's it.
So I'm here to help you out, to make the smartest move possible, and to provide you the best options possible. But then you make your own decision. Like variable rates, for instance, that's another stuff,
Yeah.
Well, I mean, you could go variable, you can go fixed, but what's the difference? What's the impact? What's the risk for me? See what I mean? So it's something that you need to know.
That's it. Okay, so let's pivot a bit. So we've spoken earlier about how the interest rates were so low about 5 years ago, and you just mentioned that exactly. We talk about 60% of mortgages will be due within the next 2 years, the 2025, 2026 here.
Correct.
So that means, say they locked in at 2%, and now it's at low 4%, like you've just mentioned, for another 5 year fix. That kind of doubles. That doubles the interest rate that they're currently paying.
Absolutely.
And they still perhaps overpaid for their house if they bought in a multiple offer situation, and they needed to represent it in the price that they wanted the house, which it was the reality of the market. So what do you see coming? What do you see coming with that? I mean, I think it's a very tricky situation. I've been hearing some people saying, like, it's going to be a big doom and gloom situation. There's going to be people that need to sell their house. They won't make it in the payments. It won't work out. We're seeing all sorts of stories. What's your perspective from being in the business?
Okay. Well, first off, I don't think it's that dark,
Me neither.
So let's keep in mind, like, what's the impact, So at one point, keep in mind that even 5 years ago, there was still the stress test. Okay, so if an individual, I gave them, I don't know, let's say 2% interest rate, which is ridiculously good.
Yes.
But let's say that's what they got, 2%. And right now they're going from 2 to, let's say, low 4. Okay, still is a pretty steep increase. I agree, fully agree. So the payment will be reflected in such, right? Okay, but what's going to be the impact on the payment? Let's say it really depends on the amount, obviously, because if you owe $100,000 on your mortgage versus if you owe $500,000 on your mortgage, 2% interest increase. I mean, we're not talking the same math here.
Yeah.
But still, let's say upon average, it represents, let's say, $300 a month, or put it at $400 a month. Okay, but back then, when you signed originally the mortgage at 2%, we still qualified you at 4. Huh?
That's it.
Yeah, even more than that, because back then the benchmark, the qualification stress test that I was talking to you about, it's always the highest between 2% more than what I give, or the benchmark, which back then was, I think, 4.64. Okay. Now it's 5.25, but anyway, I mean,
That's it. And sure, it's 5.25 now, but earlier you spoke about a way to bypass that regulation. So I guess that's
why they
the
created
exit
that
plan.
That's the exit plan.
That's why they've created that. Okay.
That's exactly why, because they know that 60% of the mortgage is up for renewal over the next few months, years.
And they wouldn't want that collapse to
No,
happen.
exactly. So what they created here is they created a way for individual to be able to negotiate with lenders and be able to actually switch mortgage from one bank to the next one without
Yes.
having to have that stress test also involved, which makes it even harder then to actually switch from one bank to the next one. Well, let's say you're paying 2% right now and you move to another lender at 4, but you still have to stress test the whole project. So I'm qualifying you at 6 instead of 4. So you just go from 2 to 6 on paper
Yeah.
when I'm going to give you 4. See what I mean? So it makes it incredibly hard to be able to switch your mortgage from one bank to the next one. So you're pretty much stuck with the bank you have. What if the bank you have offers you 6% because they know that you're
That
stuck?
you need to stay. Yeah.
Exactly.
That's a
That's
conflict of
where you
interest
go
right there.
bankrupt.
Yeah.
Yeah. So that's what they wanted to avoid. And so by doing so, when you just switch the mortgage and you can top up to $3,000, most lenders will allow to add an additional up to $3,000 amount on that to cover any expenses fee, like penalties if there's any penalties, or discharge fees or stuff like that. Like
Okay.
most lenders, to move from one bank to the next one, will charge you a discharge fee.
Okay.
You might not have a penalty because your mortgage is up for renewal, which is fine, but they'll still charge you a discharge
There's a
fee.
bit of a cost to it.
Always.
But
Yeah.
it should be a soft landing, and
Should be.
that doom and gloom situation won't happen.
Exactly. And
theoretically.
keep in mind, we still qualify you with that stress test
Yeah.
originally. So
That's it.
technically speaking,
You're solid.
you should be good. I mean,
Yeah.
it's going to be a hard hit on your budget. I'm not going to lie to you. If I tell you today, well, your mortgage is $1,000 per month, and then I tell you the next day, well, your mortgage is now $1,400 a month, we're going to say, okay,
Maybe a bit less restaurant now. or
yeah,
something,
we're going to change a few things.
Yeah.
But we'll still be okay.
That's it.
So
That's
that's
it.
what we forecast here. We don't think it's going to be that dark and that bad. We just think that people will just need to adjust.
Yeah, we're on the same page here.
That's all.
So, okay, I have two very quick subjects I'd like to cover, and then we'll move on to the signature question of the podcast.
Yep.
I wanted to discuss, I believe you can now have a 30-year mortgage. So I wanted you to expand upon that a little bit.
Okay. So it went gradually, right? You got to keep in mind that the 30-year mortgage exists since quite a while, okay?
Okay.
So the moment that you had a conventional mortgage, okay, conventional mortgage is if you buy a house with 20% down or more. Okay. You got insured and you got conventional. Okay. So the moment you're buying a house with 20% down or more, you can have a conventional mortgage, or you're going to have a conventional mortgage, which is basically lender based only. There's no insurer involved. And when the lender, it's only the lender, then you can have 30 years. Okay. So it's been a while that 30 year was existing. Okay. We just didn't see it very specifically because even if you get 30 year, you still had to qualify on 25. Okay. Again, stress test plus 25, but I'm getting 30 year. See what I mean? So it's always safe and safer.
Yeah.
Okay. But so that 30 year always existed. Well, I'm not going to say
I
always.
didn't know.
Okay. But it's been quite a while, many years that the 30 year was existing. But we didn't used to see it very often. Actually, we saw that mostly in rental properties.
Yeah, of course.
Yeah, to increase the cash flow.
Exactly.
See what I mean?
Exactly.
And usually lenders on a conventional mortgage, so 20% down and more, what they did is, you want 30 year? All right, fair enough, I'll give it to you, but you still have to qualify on that stress test. You still have to qualify on 25 years, and I'm going to give you that 30 year then. And we're going to adjust your payments accordingly. So some will actually say the variable rate, let's say, for instance, there are some lenders that will ask you, if you go 30, well, then I'm going to charge you a 1% increase on the interest rate that I'm going to give you. Okay. So 30 was existing since a while. Then what they did is they switched it to help first-time home buyers. Okay,
so that's what's newer.
That's what's new.
Okay.
Exactly. So now first-time home buyers who are buying properties can now actually access those properties with 30-year amortization, but also qualify with that 30-year amortization.
With just 5%?
With just 5%.
There we go. So that's what
Yeah.
it is. Okay,
Yeah.
got it.
Yeah. So that's what actually changed.
Yeah.
And then they added, they spread it out to also non-first-time home buyers, so
Okay.
second-time home buyers, third-time,
Yeah.
whatever you may call it,
Okay.
but for new build specifically.
Oh, yes. Okay.
Yeah.
Interesting.
Yeah, so when you're buying a new build, you can amortize over 30 year and qualify over 30 year for insured mortgages specifically.
Okay. I think that's good. I think those are good
think that's actually pretty
incentives.
good. Yeah.
It helps people to be able to qualify, of
I do.
course. I guess you pay the price a bit in the interest that you pay over the 30 years.
Yeah, but-
you may pay a bit more interest, but if you're able to get it for 30 years and invest a bit of your free cash flow that
Yeah.
outperforms whatever the 4 or 5% you're locking in at, I mean, theoretically, you're better off investing it at a higher return than stressing and going on a 20-year mortgage or something like that and putting it tight.
Absolutely. I mean, and there's no bigger expense than your mortgage, right?
Yeah.
So at the end, you might as well just trying to enjoy life.
Yeah.
And be able that if something happens with the house, that you can actually repair that house. You know, you have the money for it. You know, and also all the lenders, they actually give you access to make lump sums payments. You know what I mean?
Yes.
So
Exactly.
you can
That's
actually,
interest free.
That's interest free. That
So-
goes straight on the capital.
So just take the longest mortgage you can, and if you can, pile up some cash right before the end of the year. Put that lump sum,
Exactly.
and it's interest free.
Yeah.
And I mean, why not?
Yeah.
Why
and
not?
If your financial situation changed later on, let's say you get a job with a different position, higher income and stuff like that. Well, you can still call back the bank and say, I wish to increase my payments.
Okay.
You just have to respect those policies.
Yeah.
All the lenders, they have those policies in place that you cannot exceed a certain percentage or a certain amount of lump sum per year. And then you cannot also exceed a certain amount of increasing payment per year again. So
Interesting.
there are so many ways that you can move stuff around. So sometimes it's easier or it's better. I'm going to put it that way. Sometimes it's better to go with a 30-year and have the peace of mind just to say, okay, well, I live correctly. I can definitely afford it.
Yeah.
And
you
if-
can adjust it in the future if ever.
exactly.
Yeah.
Exactly.
Yeah.
I think that's better.
That's it. I agree. So if you could go back and give your younger self some advice, what would that be in a short answer?
Okay, well, that's maybe a little bit more personal. I would say just do it. The jump, make the move. Don't be scared.
Take the leap.
Yeah. Trust yourself. Trust your instinct. So I'm really kind of an instinct guy, and usually my instinct doesn't lie to me. I think that's like that for everyone. But anyway, but just make it happen. Go ahead. Like I was scared of becoming a mortgage specialist. I was scared of becoming a mortgage broker. Like, should I make the switch?
Yeah.
What if? Well, what if? You know? But I work hard. I've always worked hard. I love, like, really like what I'm doing. Like, I really enjoy what I'm doing. And it's something that I think I'm really like, I'm lucky to be able to do that. You know, to be part of the whole project, to buy a property with someone, that's something really exciting. Yeah, I mean, you're not buying a chair or a sofa. You're buying a house here. My God.
And you're doing a great job at it. Like,
Well,
you've been
thank you.
tailoring your services so well to my clients. It's amazing.
Thank you.
It's
thank you.
amazing.
But
I'm
that's the
sorry
advice.
to rush it.
that's fine.
We're running out of time here. So let's go to the signature question of the podcast.
Yeah.
Yan, what is your most prized asset?
Okay. So that one I really thought hard. Okay, so I was gonna say my kids. I got 2 daughters, 10 and 12. Okay, so that's kind of sketchy. All right, fair enough. But these are my pride and joy, right? I was gonna say my house. You know, the house I told you about. So I'm really proud of my house. Beautiful location and stuff like that. But you know what? I got a hockey card collection. Okay, I got between 20 and 25,000 cards.
Wow.
Yeah. I started that when I think I was maybe 6 or 7 year old with my dad.
Wow.
Yeah, and him and I just basically continued for many years, and I'm pretty sure I hit probably 25, honestly. I never actually count them. There's card on there. I might be a millionaire and I don't even
That's
know.
what I wanted to ask you. What do you think it may be worth
clue.
today?
I have no clue, honestly.
Wow, that's
Yeah.
beautiful.
I got
Like
some
it's
cards like Wayne Gretzky. I think he's like 14 or 15 years old.
Wow.
Yeah, Nylander wrote backwards. So these are kind of cards really special, you know.
Yeah,
So
yeah.
I'm really proud of that, and it's souvenirs, right?
It's always been a hobby of
We
yours
built
to
it, me
collect
and my
those.
dad together, and
That's
it was
it.
good.
It's
Time
also a family
spent
thing.
together. Yeah, and I'm a family guy, honestly.
That's beautiful.
So that's my pride and joy.
That's amazing.
Yeah, man.
Wow. Well, congratulations on where you are, sir. Yeah, I think you're in the right direction, and it's very nice to see. And yeah, we'll
Thank
keep
you.
doing some great work
Always
together.
a pleasure to work with you, man.
Thank you for coming on the podcast.
Thank you, sir. Pleasure.